Hello friends, Chris Lee, CPA here, back with another video for you. And today we are going to talk about the fundamental strategies used in estate tax planning. So when it comes to when we consider what will happen to our assets end of life, we've got estate planning, which is how we transfer our assets, but then we have estate tax planning. And so if you pass away with a substantial net worth of assets, the government may impose an estate tax on you, and it's important to discuss what the impacts are with managing those taxes, because the reason estate tax can be so devastating is the fact that estate taxes will impose tax on all of your assets regardless of their liquidity, and so that potential tax on illiquid assets makes it difficult to have the funds to pay the tax. And so when it comes to estate planning, we need to consider that. And then also, how do we transfer wealth efficiently to our heirs? So when we think about individuals and families that have built substantial wealth, we just need to know that this 40% estate tax needs to be managed accordingly. And this comes down to, there's a general framework that's been coined a term of squeeze, freeze, and please. And so basically every estate planning strategy kind of falls into this framework, and we'll kind of talk about what the pieces of that framework are. So the first piece of the framework, the squeeze, is really how do we manage what the value of assets are. So when we talk about estate tax, you're imposing a tax on what you own and the value of those assets at a 40% tax rate. So if we can manage the value of the assets and we can manage what we own, we manage the total tax impact. And so the squeeze talks about the value of the assets when we pass away. And so this is basically the objective here, is to compress the taxable paper value of an asset before it's gifted or transferred to our heirs. By lowering the appraised value of the asset for those gift or estate tax purposes, the gift tax exemption that everyone carries is maximized. And so we are basically fitting a larger volume of economic value into these the boundaries of these estate tax exemptions. So two primary mechanisms that are utilized in doing this would be, first, valuation discounts, and then making sure that we're using all available opportunities for our annual gift tax exclusions. So when it comes to gifting and estate tax planning, we have a coordinated gifting and estate tax exemption, which is the 15 million that for individuals, 30 million for married filing jointly. You can use that 15 million or 30 million up during your life, and then the remaining gets used up as you pass away. So the good news is that the government allows us to gift, currently in 2026, $19,000 to any individual without incurring a gift tax consequence. If you are gift splitting, you're married and you've got a child that you want to give $38,000 to, you and your spouse can both do that and still be under the exclusion. Gift splitting does have reporting responsibilities, but it does not reduce your exemption. But when we talk about the squeeze, we want to get the value of our assets down. So the first is valuation discounts. So valuation discounts occur when we start planning with family entities and the assets of different entities. And so valuations discounts occur when we've got, assets, that could be a portfolio of commercial real estate, private equity holdings, family business shares, that sort of thing, all kind of directly held by an individual. Those are going to be valued at fair market value on your date of death. However, if those assets were to be transferred to some other entity structure, such as a family limited partnership or a family LLC, the legal nature of the ownership changes the value of the assets. So when you retain, when you kind of transfer controlling voting shares or transferring non-voting and minority interests to trusts for your heirs, we can make a meaningful argument for why the value of those assets goes down, which is to say, if that ownership is held by an individual that has total control over those assets with no no accountability to anyone else of those assets, they're their full fair market value. They're as flexible as we want them to be. However, if we put those into an entity and we've got a combined group of interests at play, we can use valuation discounts. We can use these kind of predetermined concepts to reduce the value of the assets. So the first one of those is lack of control. So we've got minority shareholders cannot dictate policy or use of the assets. They can't force distributions or compel any sort of liquidation. So we can have a lack of control valuation discount on those entities that we've now shifted assets into, and therefore getting them out of our state. So if we move them from our personal discretion to a collective discretion, we've got a lack of control on those assets. And then the second being that private family entity shares cannot really be sold to open public exchanges, and so therefore there's a lack of marketability. So we can have valuation discounts for lack of marketability. So when we use these entity structures, we can take assets that say maybe were worth $10 million, okay, and we kind of manage them into these entity structures that provide for a lack of control and a lack of marketability. We could see valuation discounts from 25% to 35%. That's not unheard of. It's not unusual, and so that's to say, for gift and estate tax purposes, what was kind of an ordinary $10 million value, we've now managed down to $7.5 million, maybe $7 million, which can make a meaningful dent in moving assets further along without having to eat up as much of our 15 million or 30 million estate tax exemption or lifetime gift tax exemption. So that's really what we're looking at here. We want to figure out, we want to put structures in place that allow us to get the value of those assets down. The next piece are these annual gift tax exclusions. And so, as I mentioned a moment ago, we can transfer assets during our life without having to worry about the 15 million or 30 million cap that's going to be moving around. So the more assets we can move on to our heirs under these annual exclusions, the better. So that is to say, if you've got kids and you're married, it's not a bad idea to start looking at getting, $38,000 gifts to the family without having, some amount of reporting responsibilities and that sort of thing. The next thing is knowing that you can actually super fund college 529 plans. You can basically say to your, you can do 5 years of gifting in 1 year by doing these 529 plans. And so when we do this, what that is to say is rather than just being stuck at, the $19,000 of annual exclusion, we can actually super fund 5 years into it. So that's saying we could transfer $95,000 into a 529 plan, no gift tax problems, but we've gotten those assets out of our estate. When you put them into a 529 plan, they're going to, leave the estate because they're in the beneficiary. So we managed to get almost $100,000 out of our estate to one beneficiary without having to record anything related to eating up our exemptions. So again, these exemptions of 15 million and 30 million are coordinated between our life and our death. So if you've got a 15 million exemption and you transfer 7.5 million during your life, then at death you've only got $7.5 million of exemption left when you go to determine your estate tax. And so when we think about all of this, the more we can give away without eating up our exemption, the better. And the more that we can, and when I say give away, it's to our heirs, or even we'll talk charitable purposes here in a little bit, but the more we can give away without eating at our exemption, that's the goal. And that's why the squeeze is to get as much out of our annual exclusion as we can, and to get as much value of our assets down, and that might be through valuation discounts. So the second piece is what the freeze. So squeeze, freeze, please. So squeeze is to get the value of our assets down either by gifting through exclusions or valuation discounts. The freeze is managing the appreciation of assets to be outside of our estate. So once we've gotten these assets managed down and structured appropriately, the next objective is to lock in the taxable value of the asset into outside of the personal estate if we can, while legally diverting all the future appreciation to the next generation. This is really well oriented for growth assets. So this could be some IPO stock, expanding businesses, or compounding portfolios, something like that. Getting those outside of the taxable estate is kind of the goal. We usually will do this with a couple of different trust structures. One is an intentionally defective grantor trust. The second would be, it's sometimes referred to as an IDGIT. And then there's also the grantor retained annuity trust. So first, we'll talk about the intentionally defective grantor trust, which is an irrevocable trust designed to provide some structural asymmetry. One is that it is regarded as a separate entity for estate tax purposes, which is to say, if it's in the trust, it's not in your estate. And so that's the benefit there, is it gets the assets out of your taxable estate, and it's done so by being quote unquote regarded. However, for income tax purposes, it becomes defective, which is also to say it's kind of disregarded for income tax purposes. Usually this is done by crafting language into the trust documents that allow for quote unquote substitutionary powers for the assets into the trust. These powers have the consequence of, removing the overall trust, removes the assets from your estate, but for income tax purposes, you're still treated as the owner, which means you also get the tax consequences. That sounds annoying, but if you've got these high growth assets, we really just need them to get out of our estate, and we need to wind down some of our estate value. And the way we do that is with an IDGIT is the fact that not only do we get that out of our estate, however, the tax consequences when we pay those tax bills for the income that comes back to us, remember, this is disregarded for income tax purposes. So all the income tax consequences get reported on your tax return. What happens is you pay the taxes on those assets. Those assets still continue to grow without a tax drag. And the big consequence here is that your tax payments for that income does not get counted as a gift. It just reduces the value of your assets in your estate by spending, right? Like you've paid the tax bill on behalf of your trust beneficiaries. However, it doesn't get counted as a gift. So therefore, we don't eat up as much of our lifetime exemption. And so that's the big benefit of the intentionally defective grantor trust, aka the IDGIT. Now we've also got a grantor retained annuity trust. This is great if we've got volatile assets or businesses that may have some sort of near-term liquidity, and it provides a low risk freeze mechanism. So what happens here? A grantor, the person establishing the trust and capitalizing the trust, transfers appreciating assets into this irrevocable grantor retained annuity trust for a set term of years, often a rolling 2-year term or something like that. The trust is then legally mandated to pay the grantor an annual annuity equal to the original value of the asset plus this IRS hurdle rate. It's called the 75/20 rate. What happens is if these assets experience hyper growth during the term and outperforms the hurdle rate, the remaining appreciation on those assets are transfers to the beneficiaries with zero gift tax valuation. So if the asset, so that's the big thing, is we're getting the asset appreciation transferred to our beneficiaries tax-free. If the asset does not perform, it simply returns to the grantor, resulting in no lost exemption and kind of minimal administrative downside. So that's the big benefit there, is with these grantor retained annuity trusts. We get the appreciation transferred, gift tax free, but we don't have to, but the asset may transfer back. So lastly is talking about quote unquote the please. So pleasing others, that is, and that can come in a couple of flavors here. So when we've talked about the squeeze, which is the maximizing the exemption, the estate tax exemption, the 15 and 30 million. We've talked about managing the appreciation by using trusts and certain mechanisms. And now we'll talk about how we deal with the remaining one. So this focuses really on family liquidity needs, and then also philanthropic legacy, considerations that we may care about. So the first is we will use life insurance policies to potentially fund our estate tax obligations. And so the thing is with with life insurance policies is that the value of those policies, if they're held directly, are included in your estate. That's the problem. If you've got these policies and they're including your estate, you're kind of creating more tax. This is where we might use an irrevocable life insurance trust. So high net worth estates, an asset-rich families, but maybe not as cash-rich, with heavily tied up, liquidity in entities or operating businesses or real estate, have this potential liquidity issue, but they do have an estate tax consequence they need to care about. This is where we might use life insurance. So these, whole life insurance policies, or certain types of life insurance policies we'll use to help actually pay the estate tax should someone pass away. But we structure them into an irrevocable life insurance policy trust, which does what? It gets us the liquidity we would need to pay the estate tax without being taxed on that liquidity. That would be the proceeds from a life insurance contract. So an ILA is basically an independent trust that owns a permanent life insurance policy on someone that's carrying an estate tax consequence. Because the policy is owned by the trust rather than the individual, the death benefit drops to the beneficiaries 100% income tax free and estate tax free. This creates the liquidity necessary that can be used to pay the IRS for those assets, and then also replace the wealth that was gifted away during the squeeze and freeze phases of this. The next thing we'll talk about are charitable trusts that discuss how do we give assets away to in an estate tax managed way that also benefits our heirs. So for those that have for philanthropic families, we look at charitable lead trusts and a couple different flavors, which have some powerful income tax and estate tax, benefits. So when it comes to the charitable lead trust, what we're really doing is we basically fund a trust with appreciating assets. We basically let that trust have a lead period where it pays income to charities or private family foundations. So the trust is paying a reliable stream of income to qualified charities or family foundations for a set number of years. That's what's happening in these charitable lead trusts. Then the remainder, once the term ends, the remaining principal of the trust, the balance of the assets, and all the accumulated growth pass back to the children or the grandchildren. So the big benefit here is it creates a substantial upfront deduction based on the value of the assets and the income stream directed to charity, lowering the overall gift tax consequence of transferring the underlying assets to heirs. Okay, so that's how whenever we're talking about trust, any sort of annuity trust, we've got two ways of thinking about it. We've got lead trusts, or we've got remainder trusts. A lead trust is going to provide the income stream upfront, and then the remainder will go to the beneficiaries. If we've got a remainder trust that's going to, when we're talking about charitable trusts, we'll say it that way. For a charitable lead trust, it's going to provide the income stream upfront for the term of the trust, and then at the end, the beneficiaries will receive the assets at the end. So then you could have a charitable remainder trust. That is to say, there's going to be an income stream up front that goes to the beneficiaries, and then at the end of the term, the remainder goes to a charitable organization. Now, we've discussed the charitable lead trust, and that might be formed during your life, and you can fund it with assets, which is great. The second piece of this is you can have what's called a testamentary charitable lead annuity trust, which is to say that by virtue of your will, you could have an automatic, zeroing out mechanism embedded within your will, or maybe even a revocable living trust that basically transfers a certain amount of your assets to a testamentary charitable lead trust. And so that when you pass away, the testamentary charitable lead annuity trust is dynamically funded with a portion of your estate that exceeds, potentially the federal tax exemption. The trust pays an annuity to a designated charity for a predetermined number of years, structured so that the calculated value of the remainder interest passing the heirs is mathematically reduced to zero in the eyes of the IRS. However, as a result, the estate tax on those assets are, eliminated. But because they might be higher growing assets, what you can see is that at the end of it, there is actually a remainder in the balance of the trust, and then those assets then transfer to the beneficiaries, avoiding estate tax and those sorts of things. So that is the kind of what we'll get with charitable lead trusts. You can have charitable lead trusts created during your life, which you fund, or you can have kind of one that's created by will or revocable trust that's dynamic to a portion of your estate so that you can go ahead and move those assets to zero out your estate, or it could be to get your estate to a certain value that you will be accepted as being taxable or that sort of thing. But again, those are the options for people that are minded on philanthropic endeavors and that sort of thing. Interesting thing too, when you throw in private foundations to the mix, you potentially have some amount of control of the assets in some way, and you could potentially provide employment opportunities or that sort of thing for your family, which allows for a certain amount of transfer of wealth in that way as well. But this is fundamentally what it comes down to whenever we're talking about estate tax planning. How do we get the value of the assets down? How do we get the appreciation of those assets outside of our estate, right? Because they're maybe highly appreciating and exceeding the IRS inflation adjustments for the estate tax exemption. And then we're looking at how do we take care of our heirs and covering the estate tax, or being philanthropic with our dollars on the other side. So whenever we're thinking about estate tax planning, these are kind of like the areas that you can kind of a framework where you can position strategies. And yeah, that's basically the start of it. But when you're implementing these advanced strategies, it's really going to require, careful coordination, with legal, tax, financial advisors. It's kind of the 3-tier approach to get to the right answer. So if you're a financial advisor working with clients who want to chat further on this, or a client that has considerations that needs to chat through these things, certainly feel free to click the link down in the video description and we can schedule a call and chat. Looking forward to it. New video soon. Take care. Bye.